If you own a Porsche, the warning signs are no longer buried in an investor presentation or hidden inside some distant corporate strategy meeting. They are showing up in the cars, the dealerships, the resale market, the product plans, and even in the future of models that owners thought they understood. In May of 2023, Porsche was valued at more than $120 billion. On paper, it was worth more than Ferrari, more than Mercedes-Benz, and even more than Volkswagen, the company that controlled it. Investors were treating Porsche like one of the strongest automotive businesses on earth. Less than 3 years later, that story had almost completely reversed. Profit collapsed. Porsche recorded its first quarterly loss since going public. Its stock lost more than half of its peak value. The company was pushed out of Germany's elite DAX stock index, and management began unwinding billions of euros worth of investments that had been presented only a few years earlier as the future of the brand. That matters to investors, obviously. But it also matters to anyone who owns a Porsche, because the decisions being reversed today determine which cars Porsche builds tomorrow, what technology gets supported, where money gets invested, what happens to electric models, and which parts of the brand Porsche decides are worth protecting. The strange part is that Porsche did not arrive here because people suddenly stopped wanting Porsches. It arrived here because one of the most profitable car companies in the world made an enormous bet about what Porsche customers would want next, and the customers did not move according to the spreadsheet. For decades, Porsche was the golden goose inside the Volkswagen empire. Volkswagen could sell millions of Golfs, Jettas, and other practical vehicles while fighting for operating margins that sometimes sat around 3 or 4%. Porsche played a completely different game. Operating margins above 15% were normal. In stronger years, the number approached 18%, territory normally associated with exotic manufacturers selling far fewer cars. Porsche managed those margins while selling not only expensive sports cars, but SUVs and sedans as well. The 911 was not simply an engineering icon. Financially, it was an extraordinary product. High transaction prices, enormous brand loyalty, profitable options, controlled supply, and customers willing to pay premiums for increasingly specialized variants turned cars coming out of Stuttgart into cash-generating machines. That profitability made Porsche incredibly valuable to Volkswagen. When the group needed money for new platforms, factories, technology, or expansion, Porsche's earnings helped support the machine. Then the automotive industry moved into one of the most expensive transitions it had ever faced. Volkswagen was not preparing one model for electrification. It was trying to prepare roughly 10 brands for a future involving batteries, software, new production systems, new supply chains, and enormous capital requirements. The bill ran into tens of billions of euros. Volkswagen needed cash, and sitting inside the company was an asset investors desperately wanted to own. So in September of 2022, Volkswagen floated part of Porsche AG on the stock market in the largest German public listing in more than 25 years. The transaction raised roughly 19.5 billion euros. Porsche immediately received a valuation around 75 billion euros, already placing it above Ferrari and among the world's most valuable car manufacturers. That valuation was not simply a reward for decades of building great cars. Stock markets do not only price the past, they price expectations. And the expectation attached to Porsche was enormous. Porsche told investors that by 2030, more than 80% of its vehicle sales could be fully electric, not merely electrified, not primarily hybrids. Battery electric vehicles were supposed to dominate the mix. From an investor's perspective, the timing looked almost perfect. Porsche already had the Taycan. Introduced in 2019, it proved that an electric Porsche could be extremely fast, technically sophisticated, expensive, and still feel distinct from an ordinary electric sedan. The Taycan gave Porsche credibility. If Porsche could do that once, investors assumed it could repeat the formula across SUVs, sports cars, and future flagships. By May of 2023, Porsche shares traded above 120 euros, and its market value exceeded 110 billion euros, worth more than $120 billion at exchange rates around that period. Porsche had become more valuable on paper than Volkswagen itself. But the entire valuation depended on one assumption that became more dangerous with every new electric product announcement. Porsche customers had to want the future Porsche was building at roughly the same speed that Porsche wanted to build it. The first serious warning came from the Taycan itself. After the initial excitement, sales started falling sharply. In 2024, Taycan deliveries dropped roughly 49%. Nearly half the volume disappeared in 1 year. Competition had changed dramatically. Chinese manufacturers were producing electric sedans with enormous performance, sophisticated interiors, advanced software, and dramatically lower prices. But competition was only part of the issue. Porsche was discovering something more uncomfortable about its own buyers. Many people did not buy a Porsche simply because it was fast. Plenty of electric vehicles are fast. They bought a Porsche because of the combination of mechanical character, engine response, sound, steering, tradition, design, and the sense that the machine had evolved from decades of recognizable Porsche engineering. An electric powertrain could replicate the acceleration. Replicating the emotional equation was harder. Then came the Macan, and this is where the strategy moved from ambitious to dangerous. The Macan had become one of Porsche's most important vehicles, a high-volume SUV that brought customers into the brand and generated the money that supported more specialized products. Porsche planned to transition the model toward an electric-only future in Europe, making the new generation battery-powered while retiring the combustion version. In theory, it was the perfect bridge. In reality, software problems delayed the electric Macan by almost 2 years. The problem was tied to CARIAD, Volkswagen's troubled software organization responsible for developing technology that several future vehicles across the group depended on. Porsche ended up in the awkward position of preparing to replace a successful combustion product with an EV that was not ready on schedule, forcing the company to keep the older model alive longer in markets where regulations allowed it. That would have been manageable by itself. Then the battery strategy started unraveling too. In 2021, Porsche had announced its own high-performance battery cell operation through Cellforce, presenting in-house battery development as another piece of its electric transformation. The logic sounded familiar. Batteries were becoming strategically important, so controlling specialized battery technology could protect Porsche's performance advantage. By 2025, Porsche concluded that the economics did not work at the necessary scale and began winding down the plan. Another important battery relationship produced an even bigger problem. Porsche expected Northvolt to supply cells for future electric versions of the 718 Boxster and Cayman. Northvolt collapsed into bankruptcy. Suddenly, the electric sports cars that were supposed to demonstrate how Porsche's traditional two-seat models would survive electrification faced delays and uncertainty around supply. One program delayed by software, another delayed by batteries. An internal cell strategy that no longer justified its cost. None of those problems alone would destroy Porsche. Together, they revealed that Porsche had made commitments much faster than the surrounding technology, suppliers, and customers were developing. Then China exposed how serious the problem had become. In 2021, China was Porsche's largest individual market. Chinese customers wanted the badge, accepted premium pricing, and gave European luxury brands enormous prestige. Porsche assumed that reputation would carry into the electric era. Instead, the Chinese market changed faster than Porsche did. Companies including BYD, NIO, and Xiaomi started producing vehicles that were no longer easy to dismiss as lower-tier alternatives. Xiaomi's SU7 became a particularly dangerous symbol of the new competition. It offered serious performance, modern software, strong technology integration, and aggressive pricing from a company Chinese customers already understood as a technology brand. Porsche was no longer competing only against Mercedes, BMW, or another European luxury manufacturer. It was competing against domestic companies that could move faster, price lower, integrate software more naturally, and understand local buyers differently. Porsche deliveries in China fell 21% in 1 quarter during 2025. The decline later accelerated dramatically, with year-over-year China sales falling by more than half during parts of 2026. Porsche resorted to aggressive take-in discounting in an attempt to move inventory. But discounting creates a unique danger for a luxury manufacturer. A mass-market company can cut prices and advertise value. A prestige brand cutting prices risks teaching buyers that waiting will get them the same product cheaper. That can hurt residual values, annoy existing owners, and weaken the scarcity that justified the premium in the first place. Then weakness spread beyond China. European sales fell. North America softened. At that point, the convenient explanation that consumers simply were not ready for EVs became difficult to defend. especially because electric vehicles had already grown beyond half of new car sales in China. The Chinese customer was buying electric. They were simply not automatically buying Porsche's electric cars. That distinction changed the entire story. During 2024, Porsche issued 4 separate profit warnings, 4 revisions in 1 year, telling investors that previous expectations had been too optimistic. By year-end, the stock had fallen more than 30%, and Porsche eventually lost its position in Germany's DAX index of 40 leading listed companies. Then came the quarter that made the scale of the reversal impossible to ignore. In the third quarter of 2025, Porsche reported a loss of roughly €1 billion, around $1.1 billion, after generating close to $1 billion of profit in the comparable period a year earlier. That is roughly a $2 billion change in quarterly performance within 12 months. Full-year numbers were even more revealing. Operating profit fell from approximately €5.6 billion to only €413 million, a collapse of more than 90%. The automotive operation absorbed around €3.9 billion in charges connected largely to strategic restructuring, battery investments, product decisions, and reversing parts of the electric plan. Porsche's operating margin, once comfortably above 14%, and sometimes much higher, fell toward roughly 1%. For a company whose entire corporate reputation depended on making extraordinary profit from every car, that was not a normal bad year. It was evidence that the strategy itself had become financially expensive to unwind. And that brings us to the part Porsche owners should pay attention to, because Porsche's response was not to push harder in the same direction. It reversed course. Oliver Blume had been simultaneously leading Porsche and Volkswagen Group, an arrangement investors increasingly questioned as the two organizations faced massive and sometimes conflicting priorities. In early 2026, Blume left the Porsche CEO position, and Michael Leiters, previously chief executive of McLaren Automotive, took over with a much clearer turnaround mandate. Porsche started cutting away projects. The dedicated Cellforce battery operation was effectively abandoned. Porsche closed an electric bicycle venture that had been part of its broader expansion strategy. It moved away from other peripheral investments, including its stake connected to Bugatti Rimac. Management's message became far simpler. Porsche needed to refocus on the core automotive business. Product plans changed immediately. Electric versions of the 718 Boxster and Cayman, once expected around 2025, moved toward 2027. The planned K1 electric flagship SUV above the Cayenne was pushed toward roughly 2029, and combustion or plug-in hybrid technology returned to consideration for a vehicle originally designed to represent Porsche's battery electric future. The Macan became the clearest real-world referendum on the entire strategy. Porsche had intended the electric Macan to replace the combustion model. Yet in markets where both versions remained available, the older combustion Macan outsold the electric version by more than 4,000 units during the first half of 2026. Customers were voting with purchase orders. Porsche also announced plans that could eliminate around 9,000 positions by 2035, close to 1/5 of its workforce, alongside thousands of temporary and contract jobs already being reduced. Even the 911 tells you where management now sees the limits of electrification. Porsche has added hybrid technology to the 911 rather than committing the car to a full battery electric replacement. That is not an accident. During one of the worst stretches for Porsche's electric strategy, deliveries of the 911 grew about 19%, supported by demand for variants including the GTS, Turbo, and GT models. Think about the irony. The product based on a formula Porsche has refined since 1963 was gaining momentum, while products built to represent 2030 were struggling. That does not mean Porsche should abandon electric vehicles. The Taycan and Macan Electric are serious engineering achievements, and electrification will remain part of Porsche's future. The deeper lesson is about forcing a brand to move faster than its customers. Porsche treated electrification partly like an engineering problem. Build enough range, enough performance, enough charging capability, enough technology, and buyers should follow. But luxury products do not work only through objective specifications. Identity matters, ritual matters, sound matters, mechanical sensation matters. Even inconvenience can become part of the emotional value when buyers associate it with something authentic. Porsche underestimated how strongly its most loyal customers valued the things electrification was designed to remove. And if you already own a Porsche, that is why this moment matters. The company is being forced to decide which version of Porsche survives the next decade. Some electric projects are being delayed. Hybrid technology is spreading. Combustion models are being protected longer than planned. Billions of euros are being redirected. Thousands of jobs are disappearing. That can influence future model availability, depreciation, parts support, software development, collector interest, and which cars become remembered as the final examples of a specific Porsche era. The obvious interpretation is that Porsche's electric strategy failed. The more accurate interpretation is that Porsche confused technological possibility with customer timing. Electric cars did not destroy Porsche. Porsche's engineering did not suddenly become weak. The company built a future faster than the market for that specific future developed. It invested in battery capacity before demand justified the scale. It prepared to eliminate successful combustion cars before their replacements had proven they could carry the business. It entered an electric battle in China just as domestic competitors became faster, cheaper, more software-focused, and more trusted. And it allowed an extraordinary stock market valuation to reinforce the belief that an aggressive forecast was already a proven strategy. At the peak, investors valued Porsche above $120 billion. Less than 3 years later, profits had been almost wiped out. The stock had been cut dramatically. Porsche had lost its place in Germany's premier index. Major electric programs were being delayed or redesigned, and the company was planning to shrink its workforce substantially. Yet the most important asset survived. Porsche still has an identity customers recognize immediately. A 911 still means something in a way that cannot be manufactured by adding horsepower to a spreadsheet. That is why the company's current retreat may ultimately become less about abandoning the future and more about remembering what made the brand valuable enough to reach $120 billion in the first place. Porsche can electrify. It can hybridize. It can build software, batteries, SUVs, sedans, and technologies that engineers in 1963 could never have imagined. What it cannot do is assume the Porsche badge automatically makes every strategic decision desirable to Porsche customers. No company, no matter how prestigious, gets to dictate when its buyers change what they value. The customer always gets the final vote. Porsche learned that lesson at a cost measured in billions. And if you own one of these cars today, the question is no longer simply whether Porsche will build more electric vehicles. The real question is which Porsches produced during this chaotic transition will become more desirable because of what the company almost replaced them with. Do you think Porsche was right to retreat, protect combustion engines, and bring hybrids back into the plan? Or did management panic just as the electric market was beginning to mature? Because whichever answer proves correct will determine far more than Porsche's stock price. It may determine what the word Porsche means for the next generation.